just answering a little bit what among others Surbi was pointing out, how to do fundamental analysis. So how to analyze these reports, how to think about what to highlight, okay, how to do fundamental analysis. I'll just walk you through some of the material, but let's first go through this material that we were covering yesterday. So you're going to go through the paper. I'm not going to cover this topic anymore. There are 4 types of diagrams, obviously. Okay, what are the 4 types of option positions? Yeah. Okay, short put, short call, long put, long call. Okay, this comes from, you should also know the combination where it's coming from, because everywhere you have to start thinking like a computer. Even the stuff that is obvious to you, you should try to explain it through to yourself, like with baby steps, like a computer. So that comes from 2 types of positions, long and short. Okay, and 2 types of options, puts and calls. You combine them and you come up with 4 types of option positions. So this also you should go through. Everything should be disaggregated to a step-by-step analysis, explaining it to yourself as if you yourself are a computer. Okay, everything step by step. So now I'm not going to go through this in detail, but I'm going to just walk you through some of the logical ways to think about these hockey stick diagrams. Okay, these profit profiles and payoff profiles. You're going to do it yourself. Okay. But I'm just going to go through what we were covering yesterday. Have we started the recording? Okay.
Yes, sir.
Yeah. All right. So, what did we say yesterday? The first thing you notice about this diagram is, so it will also help some of the people who are not present yesterday. Okay. So the first thing you notice is, where is this? There's a part which is constant. Okay. So it seems to be, this is above the 0 line. So you notice whether it's above the 0 line or below the 0 line. Okay. In this case, you notice it's above the 0 line. So it automatically means that there's a profit. Okay. So the question is basically the question you're trying to answer when we're trying to evolve a systematic set of logical steps to find out the answer. Okay. So the first thing you notice is this is above the 0 line, so this is a profit. So it's showing a constant profit. So automatically you come to the conclusion that this must be reflecting the profile for what? Long option or short option? Yes, Ganotra? Long option?
Short option.
You're not sure because you're not there yesterday and you're not thinking through. Gil was also not there yesterday. So if the profit profile is up, if it's above the 0 line, then what is it likely to be? Short option or short option? Why? Okay, you're not clear. You have to go back and revise all this stuff. It's above the 0 line means it must be a short option position, because only when you sell an option do you earn premium. When you buy an option, like when you're buying car insurance, you have to pay out money. So it's no question of having a profit. Okay. So therefore, if you are getting a profit, that means you must be selling an option. Okay. That's what you should think. Okay. Straight away when you see this. Okay. Now the question is, so you know this is for a short option position. Now the question still remains: is it for a short call position or a short put position? Okay. So this you see. Okay. How do we work it out? You have already found out the answer, but let's look at it more logically. How can you figure it out logically so that you don't have to memorize anything? Okay. So you figure out, you look at it, you see that the strike price is 100. Okay. You see that the strike price is 100. And what is this part which is constant here? Constant profit. Constant profit has to refer to a scenario where you're selling the option and just collecting the premium. Okay, and there's no claim to be paid out. There's the option is not being exercised against you, because if you sell the option, when the guy who buys the option, when he exercises, then you have an obligation. You understand that? As the seller of the option, you have an obligation. You have collected the premium. Now if the guy wants to exercise, the guy who bought the option or who's holding the long option position, if he wants to exercise, now you have an obligation. You understand that, everyone? Right? Just like an insurance company, if you have sold fire insurance and somebody's factory burns down and they file a claim, now you have an obligation to pay on that claim, right? So same concept, you have seller of option. If there is exercise or filing of a claim in insurance, you have an obligation to pay. If you have an obligation to pay, then obviously you don't have a clean profit, because out of some of the money that you've collected for the premium, you have to pay out some of that in the claim, or maybe all of that, or maybe more than that, right? So therefore, usually it's more than that, but you're collecting premium from many people as an insurance company, so you eventually make a profit. So, but here you're showing a clean profit. Okay, that means you're not paying out anything, which means the option is not being exercised. Okay, I'm doing it in real baby steps, so but I want to make sure that everybody understands the logic, and it'll help you to understand how options work also better. So here you see this entire set of scenarios. Remember, this is scenario analysis at expiration. This is all scenario analysis at expiration, right? You have a 100 strike call, and you're asking, and you're doing a profit plot, profit and loss P&L plot for what happens if the stock price or the underlying asset price is $10, $70, $80, $90, $100, $120, $130. In each of these scenarios, what is my P&L? And I plot it and I get this graph. Okay, so I see I have a constant profit, which means I'm just collecting the premium. So it's a short. Now the what question is it a short call or a short put? How do you answer that? You see that for all prices below the exercise price, all prices below the exercise price, the below the strike price, the holder of the option is not exercising. Can you see that? Okay, so that's clear from the chart, right? There is no exercise happening for all prices below the exercise price, below the strike price. That you can see clearly. That's why you're collecting the clean premium. Okay, now there could be the question is whether it's a call option or a put option. Let's see. If it's a put option, okay, if it's a put option and the strike price is 100, okay, and the underlying asset price at expiration is 70, do you think the guy will exercise?
Yes, sir.
Rajan is saying no. Why no? Is my question clear? We are considering, now we are still confused whether this is a put option profile. We know it's a short option profile, okay, but we don't know whether it's a short put or a short call. So we are just taking them one by one. Okay, so let's say first we assume it's a short put and see if it makes sense. If it doesn't make sense, then it's probably a call, but we'll confirm that independently again. Okay, so first we take the case of a put. Could it be a short put profile? Okay, so if it's a short put profile, we are seeing a case where the strike price is 100 and the market price at expiration is 70, and we are seeing that this guy does not exercise. Is this likely?
No.
No, but Rajan is saying it's likely, right? That if you're holding up, now see what is the problem here with what you're saying. I'm going to go a little bit quickly through this. Think about it logically like this. Go back and play back the video and understand the logical steps clearly. What is the logical step here? What does the short put give you? The put gives the other guy is holding the put. Okay, he's long the put. Okay, so that gives him the right to sell the underlying asset at the strike price, which is 100. So when the market price is 70, do you have an advantage in selling the underlying asset at 100? Yes or no? Would you like to sell it?
Yes.
When the market price is 70, would you like to sell the underlying asset at 100? Yes or no?
Yes, sir.
Yes, obviously, right? Because you can make a clean profit. You can buy it in the market at 70 and sell it through the option exercise at 100. Are you following? So because the put option gives you the right to sell the underlying asset at the strike price, and the strike price here is 100, we are considering a scenario of 70. Everyone can see the fonts? You can see the price? Prahardik, last bench. Okay, so 70, we are considering the scenario for 70. When the market price is 70, if I am holding the right to sell at 100, obviously I'll exercise it, because I have a clean profit of 30, gross profit at least of $30. Is this clear? This is how you should think. Put option gives you the right to sell at the underlying asset at the strike price. Strike price is 100. What is the current market price? We are considering the scenario for 70. So current market price is 70. So if the market is at 70 and I have the right to sell the underlying asset at 100, why won't I exercise it? It's a clean profit. Is this clear to everyone? Yes? I'm not getting it emphatic enough. Yeah, okay. So maybe I'm going taking it at too basic a level, but I want to make sure that everybody understands all the baby steps. If you clear your concepts like this, then you'll never make a mistake. Yes? So you're convinced? Okay. So now you see all these cases. So obviously I'll exercise. So therefore this cannot be a put option. You can repeat this analysis for 80, 90, 100, 80, 90, 95. Okay, and what is the rule we derived yesterday? Based on the analysis that Shakshi Agarwal had given us, the scenario analysis, we derived the rule that anytime you're, in the case of a put option, when the market price is below the whenever you have positive intrinsic value at expiration, you will exercise. Remember? So in the case of puts, if the market price is below the strike, you will exercise, because you can make a profit. You sell it at the strike and the market price is, you sell it at the strike and you buy it at the market price and you capture the profit. right? In the case of calls, when there is intrinsic value at expiration, means that the strike price is below the market price. And calls give you the right to buy. We'll come to that. Okay, the calls give you the right to buy. Are you following? You have to get comfortable. Calls give you the right to buy, and if the market price is higher than the extra and right to buy at the exercise price, so therefore if I'm buying at the exercise price and the market price is higher, then I can make a profit again, buy it at the exercise price and sell it at the market, capture the profit, right? So the rule is basically for exercise or not to exercise at expiration. If there is any positive intrinsic value, you will exercise. Okay, but you should really go through the full analysis that Sakshi Agarwal gave us that day in the class. Is that you look at your profit in two scenarios. You already paid some money to buy the option, whether call or put. Now, if you exercise, are you able to reduce the expenditure for the purchase of the option, or are you able to not reduce it? Okay, so in that case, you find out in which scenario you make more money, or you lose less money, and then you exercise. This is clear? Okay, so the basic rule is that whenever there is positive intrinsic value, you will exercise the option. So here we can see clearly, yeah, I'll just come to you. So here we can see clearly, at least the first part of our analysis, that this cannot be the profit profile for a short put, because it's not showing what we would expect in a short put situation. Yes, Tarun. Use the mic. Give him the mic, Sakshi.
Sir, as you are saying that we will actually minimize our losses. If there is a scenario, in those scenario only, that there is a profit in some of the scenario. In for the scenario, there is a situation where we are getting a positive intrinsic value, whereas you are saying that we will also take into consideration that situation where intrinsic value will be reducing our losses.
Yeah.
So I'm asking whether we will also apply this situation or consider this situation even if we are having a situation where we are having a positive intrinsic value. Then we will
I didn't understand your question.
Will you take
First,
a positive intrinsic value, sir?
no, give me an example through whatever you're saying. If
Sir,
you can.
for example, that you are saying that at that time when Sakshi gave an example, we were having a loss of $2. Whereas
In which scenario? Whether you exercise.
when we were exercising and there was a premium of
Well, shut it
7,
properly. Is it properly shut? Yes,
and there was a premium of 7, whereas actually the market price was giving us a profit of only 5. So we exercised at that time and taking a loss of $2.
Okay.
That was what Sakshi said.
Yeah.
So I'm asking, when there is a loss of $2, whereas we also have a situation where market price may be more than $10. So we'll be having a profit of $3 over our premium of $7.
No, I'm still not. Let's take an example actually. One sec. I'm still not able to follow what you're saying. See, let me explain the rule once again. For exercise, the rule is very simple, whether you'll exercise an option or not. Okay. Your question of exercising the option only arises when you're long the option. When you're short, that's not your decision to make, because the other guy is making that decision. Okay, the guy who's long the option. So when you only have to decide whether to exercise or not when you're long the option. Okay, and if you're long the option, you can clearly see that this is the kind of profile that you have, like this kind of profile when you're long the option, because there'll be a constant loss profile, because that is reflecting the premium you paid to buy the option. Okay, so and this is for all the scenarios where you don't exercise the option, you have that constant loss. And here you can see that your loss starts to reduce. Can you see that? So it is not actually the premium, is basically from the strike onwards, and that's where we come to this rule of intrinsic value. So whenever there is positive intrinsic value, you understand what can you capture if there is any positive or zero profit, positive profit. Sometimes if for at the money options we say intrinsic value is 0, okay, or even for out of the money we would just put it at 0, not negative. Okay, so the point is that you have already paid out some money for the purchase of the option. Now the only time when you will exercise is when exercise itself gives you just that isolated activity of exercising the option and squaring the position in the market. If it gives you any kind of positive profit, you will exercise it. And that's what I'm saying when I say, when will it give you a positive profit? When there's positive intrinsic value. Okay, so you have to write it as intrinsic value has to be written separately for calls and puts, because in the case of calls, intrinsic value will be positive when the market price is above the strike. Remember, when the market price is above the strike for calls, because calls you'll buy it at below the market and sell it in the market, capture some profit. In the case of puts, the market price will be below the strike, because you'll sell it at the strike and buy it back in the market and capture this profit, right? So whenever there's positive intrinsic value, it makes sense for you to exercise the option, because it allows you to reduce your total, even if the total profit captured, okay, like in this case, you paid $7 for the option, okay? Now, even if the market is at 68, it still makes sense. At 68, what is the intrinsic value of this option? How much intrinsic value do we have at 68? Shivam? In the put option, now we are looking at a put option. So I bought a put option with a 70 strike, and the market price at expiration is $68. So what is the intrinsic value of this option? $2. Somebody told you, Burma told you, so you are just repeating $2. 70 minus 68. Okay, so intrinsic value is basically you have to figure out what can I make by exercising this option and squaring the position immediately in the market. Okay, what can you capture that way? You exercise at 70, you sell it at 70, and you buy it back at 68, you capture $2. So there's positive intrinsic value. So whenever there's positive intrinsic value, what it does is it allows you to reduce the total, either reduce the total amount of premium, the net premium that you end up paying. First you pay $7, and then eventually you are able to reduce and make $2 profit, so your total loss is $5. Okay, or in this case, sometimes the intrinsic value may be more than, like here the premium is $7. You have to only make up $7 to get to zero, but the intrinsic value may be $25. In this case also you will exercise. So whenever there's positive intrinsic value, you will exercise, because it either allows you to reduce your total loss or it adds to your profit. Okay, does that clarify your doubt? Okay, so this is the way. Is everyone clear about this? Remember all these concepts, because repeatedly I'm seeing cases where I'm asking questions about concepts that have been taught in the class. Okay, either cases like you do where you are not present yesterday. Okay, so you have to revise what is being taught. Okay, that's why the videos are being put up, so you can easily relive the whole class. The only thing you can't do is ask questions because you were not there, right? But you can ask questions the next day about what you heard, right? So you have to revise these concepts. If you're not learning this concept, this entire time exercise is a waste of time for you, because after one semester you'll forget everything. Then what's the point? When you go for your interviews, if people, I don't know if people are going to ask such technical, most of the time people don't seem to ask technical questions, especially not on derivative products. Okay, they ask questions like how many brothers do you have, what's the name of your dog, and all this kind of stuff. So, but sometimes they do ask technical questions, like care ratings asked a lot of technical questions. Okay, so so this part. Okay, so is this clear now? We go back to having taken that detour to answer Tarun's question. We are going back to the, let's say, this particular case, right? I'm trying to teach you the logical steps that you'll go through. Please make sure you go back and practice and satisfy yourself that you're able to crack all the diagrams in this way. If you don't do that exercise, you will not understand it. Okay, and if you do it once, you'll understand it for life. Then you don't have to ever revise this stuff again. Okay. So what did we say? We see that there is a constant profit in scenarios where the market price is below the strike price. Okay, so this cannot be already proved that this can't be for a put option. Okay, so therefore it must be for a call option. But let's satisfy ourselves, okay, that it's actually making sense for a call option. Okay, which is, so now let's look at it. So it's a short position, that's why we have the positive premium. Now does it make sense from a call option point of view? Okay, so what is happening here? Say, let's say we take a case of $80 when the underlying price is at $80 at expiration, okay, and the strike price is 100, and we see what is actually happening. Okay, what is happening here? We are seeing that there's a case where the guy is not exercising, the holder of the option is not exercising. Okay, that's why I'm able to capture the full premium, right? So does it make sense when the market price, in the case of a call, we are considering a call option, in the case of a call option, the strike price is 100 and the market price is 80. Does it make sense that the holder is not exercising the option? Does it make sense? No? Who is saying no? Tanya? Give her the mic. Why does it not make sense? Is my question clear? Yeah, is my question clear?
Sir, if the market price of underlying asset is 100.
No, market
Oh.
price is 80. We are
Then
considering what? No. Does it make sense or does it?
No,
Maybe my question is, you have to pay attention to my question. The question is a little convoluted. Now, Gavarma, don't help her. The question is a little convoluted. The scenario, the facts are these: that the strike price, that's a call option. Okay, the guy is holding a call option, and the strike price is 100. The underlying price at expiration is 80. And the facts are showing that the guy did not exercise the option. Now, question is, does it make sense? Your answer was no.
The strike price was 100 and the exercise price is 80.
Strike price and exercise price are the same.
Sorry, market price is 80.
Yeah.
So he should not exercise it.
Yeah, so it makes sense. The answer to my question is it makes
Yes.
sense. So first you have to answer the question as it is framed. Sometimes you have like questions with double negatives. You know, like, so all kinds of, like when you board the aircraft, you see they have these questions. Did somebody never check? Did nobody ever check this bag before? Did nobody interfere with this bag after you packed it? That question actually has a double negative, the way it's framed. So you have to be careful about how the question is framed. So is this clear, guys?
Yes.
That it makes sense? That why should he exercise? Because what would he do if he exercised the call option with a strike of 100 gives him the right to buy at 100? Okay, so why should he buy at 100 when the market price is 80? Because he can buy it cheaper at 80 in the market, right? So he should not buy. There's no profit here to be made for him. So it makes complete sense that he's not exercising. Okay, now let's confirm it one more time. Let's look at the last example of 130. When the price is 130, when the underlying price at expiration is 130 and I have sold a call, we are still confirming the call situation. We are just being 100% sure that it's a call. So I sold a call and the holder of the call, and what is he doing? It shows that what is my situation when the underlying price is 130. I'm making a pretty big loss, probably something like 25 or something like that. Okay, so say $25. I'm making a loss of $25. Now, does this make sense? Yeah, because when, first of all, will he exercise? Because obviously this is in negative territory, means I'm not able to keep all my premium, so which means the guy must have exercised. Okay, so first of all, first ask the basic question: when the market price is higher than the exercise price and the guy is holding a call option. Okay, the market price, which is 130, is higher. Market price is 130, the exercise price is 100. Okay, and the guy is holding a call option. Does it make sense that he will exercise? Why not? What is the rule of exercise? Go back now to the rule of exercise. Positive intrinsic value. So when the strike price on a call option is 100 and the market price is 130, we have shifted our discussion now to the call part, no? Right? Because if it's not a boy, it must be a girl. So now it was not a put, so we have assumed that it's a call, but we are just reconfirming that it's actually a call, right? So we are now in the call situation. So is this clear?
Yes, sir.
Right? That when the market intrinsic value is positive, so he will exercise. Is this clear? Okay. So he will exercise. So that is consistent basically with the fact that it's not showing me the constant profit, it's showing me a loss. Okay. Now what is the extent of the loss? When he exercises the option, what do I have to do? I have to, now coming back to the obligations of the option seller, who is also referred to as an option writer. Okay. So the obligations of the option seller, in a situation where basically the obligation is that whenever the holder of the option wants to exercise, okay, now the holder of the option could be a madman also, he might want to exercise even when there's negative intrinsic value. The bottom line is that you have to follow his instruction. You have to basically allow him to exercise. That's your obligation under the contract. Okay, remember, option is a contract. Okay, so you have corresponding obligations. Okay, so in this case, the guy wants to exercise the call option, which means, what is the strike price? 100. The call option gives the holder the right to buy the underlying asset at the exercise price, at the strike price. Okay, so therefore you will have to sell him the underlying asset at 100. Okay, you will have to sell him the underlying asset at 100. And what is your loss situation? And now remember, you can't have you have to have a square position. You have to calculate all your P&L situations, assuming that you have squared all your positions. So if you have to sell the underlying asset at 100, you need to buy it back. Okay, or you need to buy it first. So there you have to buy the underlying asset, and what is the market price? 130. Okay. So you have to now buy the underlying asset at 130 and sell it to him at 100. So you're losing $30. Is this clear? You have a loss, but earlier you collected $5 of premium. Yeah, but I'm saying on a gross basis, on the exercise on a gross basis, you're losing $30, okay, and then adjusted for the premium, you're losing $25. That's why you see that the plot here, the plot here is that 130 minus, you drop this here, 130, the corresponding plot is minus 25. You can see this, okay? So it's minus 25. So you can see this is reflecting the fact that you lose $30 on the gross exercise part of it, and then you adjust it against $5 income received for selling the option. Okay, so now what was I saying? So okay, one more thing, always remember, these prices are, you're the only one going out, Garvit. Please come back before 3 weeks. Hey, don't go out for 3 weeks now. Please come back. 1 minute, Garvit. Come back. Hardik is out. Okay. Yeah, if you're not feeling well, you can go. Okay. So Aurora will take over the doorman duties. Okay. All right. Okay, guys. One more thing. Always that must be in your head. Always, whenever you're looking at these hockey stick diagrams, they are not adjusted for the time value of money, which is a cardinal sin in finance. So that thing should always be, that aspect should always click in your head. Whenever you're studying these, the reason we plot as minus 25, actually it should be minus a little more than that, because you also have to fund that $5 premium. That $5, let's assume this is like a 1 year option. So you bought that $5 at the beginning of the year. Where did you get the money from? You assume that you borrowed it and paid the $5. Okay, so you have to take the interest cost or the funding cost or the cost of equity at least, or some kind of funding cost. All capital has a funding cost. So strictly speaking, in finance, to calculate your profit here, the profit is actually less than $5. The loss is more than 25 actually. Okay, so this thought must always, whenever you're looking at these hockey stick diagrams, this must always, you will still draw hockey stick diagrams without using time value of money, because that is the way the market draws it, the convention. But whenever you draw it, it must always click in your head that these are done without time value of money calculations, which is a cardinal sin in finance. We must always adjust for the time value of money. So this consciousness should always be there in your head whenever you're looking at this, remember that there is a flaw in these diagrams because we don't adjust for the time value of money. In practice, you will have to adjust for the time value of money to calculate your true P&L. The true P&L will be worse than 25, worse than minus 25, because you will have to adjust for the interest cost of the $5. You paid $5 at the beginning of the year, and this profit realization is happening at the end of the year. So what about the funding cost of $5 for 1 year? Remember, that must always go through your head. Is this clear? Okay. All right. Now, before we go, wow, it's already 5 to 12. How did time pass so quickly? Let me just okay, so I just want to give you the little bit of this is today's date. Okay, so I just wanted to give you this. I've given you the link already, it's in your notes. So there's a lot of, this is on the 30th. Okay, so there's analysis of both Facebook and Amazon on this. Okay, I hope my voice has, I don't know whether this is only for the speaker. I hope it doesn't affect the mic volume. I don't know what the mixer is actually. Yeah, if you click on the mixer, you'll get to see. So I think everything goes together. Is there a microphone? Anyway, we'll see. In the worst case, you'll have to turn up the volume somehow. Okay, so I should have turned it up earlier, because we don't know whether mic I think the mic volume gets adjusted from the Flashback Express menu. So yeah. So anyway, so we'll see. So if you go to the beginning of this for some, I think maybe this is this particular network doesn't allow me to stream YouTube. But anyway, you look at it. This particular program, they analyze both Apple earnings and Facebook earnings. Okay, so therefore I think they've done the Facebook earnings also, because they came out on the same day, and Facebook has really done very well. So please go through this. You'll get to know a lot about how analysts look at earnings. Okay, so this is a very major profile. If you're looking at an equity analyst kind of profile, you'll get a very good, even if, as a debt analyst, you get to see a lot of the company analysis, the kind of questions you look at, the kind of metrics you look at. There is a little bit of overlap between equity and debt analysts. Okay, so therefore for all kinds of jobs, that's why I told you to focus on 2-3 companies. In the US, you take some big global companies like Amazon, Apple, Netflix, Google, these guys, Facebook, and in India also you take some big large cap companies and you analyze what's happening, all the news that comes out. Okay, all kinds of news, watch the stock price. If you do this, it gives you really good in-depth understanding of some major companies. Okay, but also what it does is, because the basic questions that you ask, the kind of logical analysis steps that you go through, you can apply it later to all kinds of other companies. You can learn a lot about how to apply it to other companies. So there's a process in gain also in terms of how. Are you following what I'm saying?
Yes, sir.
So go back and watch it, and then you get to see about all the things like all the questions that the analysts ask. Okay, so that's just, that link is already there in your thing. Now we go on to our next topic, which is, so this linear payoff, we have already done, and payoff and profit. So please make sure you go through the logic that I covered, okay, and satisfy yourself on all the other payoff diagrams. Okay, profit and payoff diagrams. Okay, so next topic that we are going to is positions and synthetic equivalents. Okay, so here now we are going to consider positions in. First, let's be clear about how many positions. Now we actually have 6 positions, because we are talking about positions in both options. So how many types of options positions do we have? 4. And how many types of underlying asset positions do we have? 2. Okay, so we combine all together, that means we have now 6 types of positions. Okay, this is all in your notes. These are your notes. Session outline is your notes. Everything is there. There's a lot of notes now, so there's no reason to complain. You still should watch, because everything can't be put into the notes, so you should watch the videos, because a lot of detailed explanation which we are doing in the class. Okay, all right, so now what are we going to do? We are going to look at these positions, and we are looking at synthetic equivalents. Okay, so this is a very important concept in finance. Okay, especially later on when we do arbitrage and things, classical riskless arbitrage. The concept of a synthetic position or synthetic equivalent. What is happening? You're disturbing her, or you've taken a pen. Why have you taken a pen? Oh, it's your pen.
Sir, no, he is taking from here.
Okay, give her. Even if you have 2 pens, give her a pen. So that. Okay. No, anyway, all right. Okay, guys, one sec. Let's concentrate. So now we are talking about 6 positions. We're talking about 6 positions: underlying asset, long underlying. So this is the coding that I've used. Very simple. You understand: long underlying, short underlying, short put, long put, short call, long call. Okay. So I'm not going to write it in full. You can figure it out. Okay. So we are now going to look at synthetic equivalent. What is a synthetic equivalent? A synthetic equivalent basically is any position that allows you to create the same kind of economic outcome. Okay, so if I'm saying synthetic equivalent of a long underlying, okay, long underlying, what is the underlying outcome? If you look at the payoff profile, remember yesterday we looked at, well, we don't want this actually. Here, what is a synthetic equivalent? Okay, this is our long futures position. Is this clear? You remember we discussed this yesterday? Okay, for those who are not there, you have to watch the video again. But we have discussed it yesterday, why this is a payoff for a long futures position. Long futures, long spot, long forwards. Okay, this is the futures position, payoff, because you are long at this price. When the market price goes to this place, you are making this much profit. Okay, is this clear? This is why this is the long futures payoff profile. So a synthetic equivalent is nothing but, in this particular book may actually mention synthetic equivalents. Yeah. So if you go through this CME option strategies book, which is in your finance reference folder from IPM, okay, it's in your finance reference folder. You will find this book. You should have already downloaded this by now. The CME option strategies, if you look at this, you will find that every position has a synthetic mention at the bottom as well. Okay, so what do we mean by synthetic? Essentially, this is how you think about synthetics. Okay, synthetic is any other position. Okay, so this is your long call, this is your long futures position. Okay, so a synthetic equivalent of we usually talk about synthetic equivalents. Okay, a synthetic equivalent of this is any set of positions, okay, other than this position, which indirectly creates the same kind of economic outcome. Okay, this is by economic outcome we mean essentially the payoff. Let's talk about, be more specific, use the language of finance specifically and call it a payoff. This is the payoff. So any other set of positions which I can use. So this is my long futures profile. Okay, this is my long futures payoff profile. This is what, is everyone clear about that? We have discussed it yesterday. As if I'm long at this price, as the market goes up, as the market price goes up, I start to make money, and as the market price falls below the price at which I'm long, I start to lose money. Okay, so this is a long futures profile. So a synthetic, now we are trying to just understand the concept of a synthetic equivalent. A synthetic equivalent is nothing but a position where any set of positions, okay, by which I can actually indirectly create the same payoff profile as this position. So a synthetic equivalent of a long futures position will be any set of positions and other instruments, okay, other instruments through which I can create the same net result. Is this point clear? Okay, the concept is clear. Okay, it's a synthetic equivalent. Okay, now understand this. Let's understand the first example. Our first item anyway is long call, long underlying. Long underlying, so everyone clear about synthetics? Now you'll understand a little bit more once you see the first example. Okay, so this is your, I've given the contents also for your 10th edition, I think, for Hull Basu. Okay, no, sorry, this is for Nattenberg. Hull Basu is 12.2. You have to go to 12.2, but I'm explaining it. Let's go to Hull 12.2 also. Okay, let's see, what are we trying to create now? These guys haven't done, they've only done the option equivalents. Okay, we will do the futures also, so that therefore we'll look at these guys have done only the, okay, so they have only done the option equivalents in this profile. So let's go back to CME option strategies and let's look at this. So this is your long futures position. What is the synthetic equivalent of a long futures position? Anybody wants to guess? Just think about it conceptually, knowing, can you create a long position? Can you create the same result as a long futures position, okay, by using options? Is my question clear? The result is basically we want the same payoff. The result here we mean same payoff. Okay, same, in general terms we will say economic outcome. In specific terms we can talk about payoffs. Now you understand what a payoff is, payoff diagram. Okay, so we want to, this is a long futures payoff diagram. Okay, so we want to create the same payoff diagram now using other instruments, the synthetic equivalent. Yes, Padarun, use the mic. Is my question clear? What are you trying? You're trying to create the same result, same payoff profile by using instruments other than futures. Now specifically using options. How will you do it? Instead of going long futures, what are my alternatives? It's like saying, instead of going straight from here to Gurgaon, can I go by some other route, reach the same destination, create the same outcome? Okay, so yeah.
So we can buy underlying asset. Like
this is already long underlying asset. This actually is, if you see.
Sir, two options I'm saying.
1 minute. Let me. This is a little bit too big. Let me make it a little smaller. Let's make it 150 where we can see maybe. Yeah. So this is already long futures, okay? Yeah, so what I'm asking you is, can you recreate the same payoff profile by using options? This is futures. Now I don't want to go straight from here to Gurgaon. I want to maybe by car taking the shortest route. Maybe I want to go by the metro. Okay, so some other route. So I'm not talking about this straight route by the car. So this is the equivalent of the futures position. I don't want to take the long futures position, but I want to create the same result as the long futures position by using options, buying, selling, whatever you want to do, calls, puts, buy, sell. Is my question clear? Can we create the same result? Think about it this way. Okay, long futures, when the market rises above the strike price, when this is the K, right? In your notes, I have written it as K. Long underlying at K. Everyone understands this notation? No need to expand it. LU at K. K is just a price. Okay, K is just a price. K is the same as A over here. A is just indicating a price. Okay, it could be 100, 80, whatever it is. Okay, so it's just indicating, instead of A, I've written K. Long underlying at K. Let's go with this chart and let's look at K. Let's look at A. So if I'm long at A, okay, let's say A is equal to 100. When the market rises above 100, I'm making money. So basically, what am I trying to do? I'm trying to create a synthetic equivalent of the long futures position, which means whatever I do, conceptually think about it. And let's say we are just talking about, so what are the four options? We have only long call, long put, short call, short put. Can I combine any of these positions in some way to create the same result? Okay, so let's look at one side of the result. Okay, so one thing I must have is that when the market rises above the A, when the market rises above A, I should make money. Okay, and when the market falls below A, I should lose money. Right? If I have to have the same result here, if I must have the same result as the long futures profile, right? Long futures position. Are you following my question? What are we trying to do? We are trying to do something. It's like catching your ear like this. Okay, so I want the same outcome, but I want to do it in a different way. Okay, so instead of using futures, I want to use options and create the same result. So what is the result? What are the two parts of the result that we have broadly? When the market rises above the price at which I'm long, okay, above the price at which I'm long, I should make money. And when my market falls below the price at which I'm long, I should lose money. This is what this profile is showing, right? Okay, so let's take the first part and let's do one thing. Since we are dealing with options, I've already given you a clue. You're not using swaps or forwards or spot or anything. I've already given you a clue that you're going to use options only. So you have only 4 types of positions that you can take to create this position. So in this case, let's set A equal to the strike of the option. Okay, let's take A and since options have strike prices, let's have A equal to the strike of the option. Okay, so in this case, what happens if I have a situation, if I have A equal to the strike of the option and I want to recreate this profile with options, okay, long and short positions and calls and puts, then one of the things I can do, think about it, what kind of position, because remember, what are we trying to get, what are we trying to achieve? One part of it, just look at the right side. We must have a situation where when the market price rises above the strike price, I should make money, because we have already set now that A is the price at which I was long the futures, and for this exercise I'm setting A equal to the strike price of the option, because we know options have strike prices. Okay, so try to follow the logic how we are trying to get to the solution. So what do I need to have? First half of it, long call is one example, because long call will make sure that when the market price rises above the strike price, I should make money. I will make money if I am long a call, then when the market price rises above the strike price, I should make money, right? But now, is it enough just to have a long call? Because what happens to the long call when the market price drops below the strike price? Let's go back 1 minute. Short. Okay, let's go step by step. Before, I think Parul may be jumping ahead a few steps. Let's go back to okay, let's see if we can right. Let's see if we can make you ignore the dotted lines. Let's focus on this C. chart number C, figure C, okay? Forget about the dotted lines. This black line is what position?
Long call.
Long call. Straight away you know it's a long because it's got the portion which is below the zero line, which means loss, okay? Loss, but it's a constant loss, and this must be a call because as the market price rises above the strike price, this is another logic that we are introducing, this position is making money. If the market price rises above the strike price, and for all situations where the market price is below the strike price, there is no exercise. There is no exercise. That makes sense for a call because in the case of a call, when the market price is below the strike price, why should the person exercise? Because that means he's having to buy, he has to buy the underlying asset at a price higher than the market price. Now he's not a fool, he's not going to do that. He will not buy it at a price higher than the market price. So therefore there is no exercise whenever the market price is below the strike. Okay, so therefore it makes sense that this is a call profile, just a dark line here. Okay, so this you see the long call profile. So we go first with what Sakshi Jan has told us, that this is we can use a long call. So it satisfied part of our objective, that it is giving us this part of the graph is fine because this part of the graph looks like where did I, okay, so this actually is in the same, this part of the graph here looks like what we need here, right? It has the right side of the graph, it gives us the right side of the graph, but the left side of the graph is not working out with the long call because you can see here it is symmetrically dropping. This is why we said they are called symmetrical profile. Spot, forwards, futures, swaps, we call them symmetrical non-linear instruments. Okay, so another set of words that we use is linear versus non-linear and symmetrical versus asymmetrical. Okay, symmetrical, you understand, symmetry means equal on both sides. Basically there's some kind of balance. So here it's symmetrical because basically you can see the chart looks the same, whereas an option chart is not symmetrical. An option payoff profile is not symmetrical because the look of the graph on either side of the cutoff point, which is the strike price, the look of the graph is not the same. Here it is moving in line with the market, and here it is a constant, so it is asymmetrical. So by referring to what we did yesterday, one of the topics we covered yesterday was linear versus non-linear payoff profiles and profit profiles for instruments, and what we said was spot forwards, swaps, options, spot forwards, futures, options, futures, swaps, sorry, I keep making it. So spot forwards, futures, swaps, okay, will have linear profiles. Okay, so in some cases of swaps there will be some kind of convexity, we don't need to worry about that, but those are linear profiles. So another word you can use for linear is symmetrical, okay, which is this is linear and it is symmetrical because it is equal on both sides of that cutoff point. Okay, and for options we say non-linear, okay, and asymmetrical because it's not symmetrical. This side is looking different from this side of the cutoff point. Okay, so non-linear, another word is asymmetrical. Okay, so the first part of the long call helps us with this part of the curve because it looks like this, but we need to create this part of the curve. It's not matching with the long call position that we have. Okay, so anything else? So synthetic equivalent means you can use multiple positions, and usually you have to use multiple positions. Okay, so long futures, we are trying to, what are we trying to do? We are trying to create the synthetic equivalent of a long futures position. Okay, so one part of it is correct. One of the parts to our story will be long call. Sorry, what did I say? Long. This is actually long futures. This is long futures. Okay, but we are trying to create a synthetic equivalent by using options. Okay, of a long futures. We are trying to create the synthetic equivalent of a long futures position by using options. Okay, so one part of it is a long call position. Okay, I'm going very slowly because I want to make sure that everybody goes baby steps. Okay, everything should be clear. Okay, all right. Okay, now now one is long call. What is the next part? Any other ideas? What else? Short put. Okay, let's look at the short put. What will the short put do for us? Let's look at a short put profile from here itself. Which is the short put profile here? B is a short put? Yeah. D is a short put?
Yes.
You agree? What happens in D when you're short? Obviously it's a short position because you're making a profit, okay? But is it a short put here? What happens? Let's look at it. It is showing that there is a loss. There is a loss when the underlying asset price, you're also going out. Hasn't somebody already gone out? No. Pratik is also out? Huh? You're having a headache? Okay. Now what is it? You also you want to go? No, who is outside? Pratik. Chug is outside. Just wait. Tell all your batchmates to make sure that they come back properly. Come back quickly on time. Garvit is back? Okay. Garvit is on. Once Garvit goes out, no one else can go out. Okay. Alright, okay. Alright guys, let's get back to work. So Sakshi is saying this is actually a short put. Let's check whether she's correct. It is showing a big loss in a situation where the market price, let's take ST, let's take the last one, okay? It's showing a big loss. Let's say assume that ST is here, okay? Now it's showing a big loss when the market price is higher than the strike price. Is this clear to everyone? You agree with my assessment of the graph? The market price is higher than the strike price and the situation is showing a big loss, okay, which means the guy must have exercised and I had to take a big loss to basically satisfy his exercising the position, okay, to fulfill my contractual obligation. Now the question is, when the market price is higher than the strike price, will the holder of a long put exercise? What are we seeing here? This is graph D that she has referred to as a short put. We are checking to see whether she is correct, okay? In this graph, let's assume that this just perpendicular to this is the ST, okay? Now ST is higher than K. K is our strike price. Now if it is a long put and the market price is higher than the strike price, okay, which is what we see here, we are considering this situation where there is a big loss and we assume that we drop a perpendicular, this price is ST, okay? Are you following so far? Okay. Now when the market price is ST, ST is obviously higher than K.
Yes.
Yes? On the graph, ST is higher than K. ST is the market price, K is the strike price. So when the market price is higher than the strike price, will the holder of a put exercise? No, because the put holder has the right to sell the underlying asset at the strike price. So why should I sell at K when I can sell in the market at ST? Is this clear? So this cannot be a short put profile, because even if he exercises, actually this is actually a loss. If the guy exercises, he will sell at K and have to buy back in the market at ST. So he'll make a loss. So if he's making the guy with the long position is making a loss, I being the short position holder, I'll actually make a profit. So this can't be a short put payoff profile. Is this clear? Have you understood? I don't think everybody is 100% clear. You need to go back and revise. Make sure you understand all these points that are being made. Are you following what I'm saying?
Yes.
This cannot be a short put profile, because in the short put profile, it's showing that I have a big loss in satisfying the exercise of the option, okay, in fulfilling my contractual obligations in a situation where the holder of the option exercises the option. I'm suffering a big loss. This can't be, because actually the holder of the option will suffer a big loss. If he's holding a put and he sells at the strike price of K and buys back in the market at ST, he will suffer a big loss, not me. So this can't be a short put profile. How can it be long if it is showing profits above the zero line? So this is actually, indirectly we have discovered that this is a short call. Okay, you two are involved in your own discussion. They're disturbing you. Okay, please pay attention to what is going on. Okay, so 1 minute. Coming back to Tarun's point, this can't be a long long call position because it is showing a portion above the zero line. Long call can't have a long position, won't have a portion above the zero line. So it's a short call. So it's a short call. Eventually, by the process of elimination, you have come to the conclusion. We saw that it could not be a short put. Okay, we saw it could not be a short put. Then he said it's a long call. Long put first, whatever you said, long put. Okay, so that it can't be a long put because it's got a portion above the zero line. So through a process of elimination, you have come to the conclusion that this is a short call, right? So eventually, like you know Sherlock Holmes. Have you heard of Sherlock Holmes? So Sherlock Holmes's strategy for analyzing cases was that, as he told his partner Dr. Watson, that once you have eliminated the impossible, whatever remains must be the truth. So that's how he used to come out to the conclusion of what actually happened in the case. Okay. By the way, Sherlock Holmes case stories, if you want to improve your written English and even that'll also improve your spoken English. Okay, you guys may not want to read Charles Dickens and Shakespeare and all that, but Sherlock Holmes, I think everybody likes reading mystery stories. Sherlock Holmes, most of the stories are out of print, out of copyright. Okay, so if you go on and very, very high quality English, okay, very good quality English, correct English. So one way of improving your written and spoken English is to go back, just search on the web, and you'll find most of the works of Sherlock Holmes are actually out of copyright. Conan Doyle was the author, and you can read those stories. It'll be very good for your English comprehension, English writing, etc. Okay, so sorry. You bought it on Netflix. No, then watching on Netflix won't improve your English. I'm trying to improve your written English. Okay, I'm trying to improve your written English and your spoken English. And I accept that you are not going to go and read Charles Dickens and Shakespeare. So I want you to read something which I think everybody will like reading. Okay, instead of reading these stupid modern writers, okay, whose English is very bad, it's better to read Conan Doyle with very high quality English and stuff that is good for you. Okay, is this clear? Okay, watching TV is not really adding to your skills. Yeah, you watch proper business programs. Okay, all right, guys. What have we come to the conclusion by a process of elimination? We have come to the conclusion this D profile is a short call. Okay, but it hasn't solved our original problem. What is our original? We still need to find something to create this part of the profile. We need some kind of option position which makes us lose money. Think about it. We need some kind of option position out of the 4 possible, which is going to make us lose money when the market price drops below the strike. This particular long futures at this X price A, we are taking this to be the equivalent of the strike price for the sake in the case of options. We need some kind of option position which is, think about it this way, which is going to make us lose money when the market price drops below the strike price. What kind of position would that be? Short put, right? So if we go short a put, then as the market price drops below the strike, we'll be losing money. Okay, so now let's look at this. Let's go back to this and see long. And therefore, if you see here, when you look at this is a very good book that you should also go through. There are 25 different option strategies, lots of advanced strategies, condors, butterflies, this, that. This can become an topic for you. Remember, for when you are preparing for your options, for your interviews, not just for interviews, but even for your, so here, somebody come back. I thought you were going.
No.
Gil, why are you going out now? Where is Chug? Now Chug has also gone on holiday.
What is this?
Chug wait, let Chug come back. Where is Chug? Call him. Where is Chug? Call Chug, let him come back. Let's have some discipline. Otherwise, then everybody can go out. What's the point? If one person can go, then everyone can go. Okay, guys, let's get back to work. 1 minute. Let's get back to work. All these strategies, yeah, call him. So all these strategies here, all the CME option strategies, if you go through what I was telling you is this can be one of the topics you focus on. Remember, when you're going for your interviews, you should have some questions ready. They're going to have two kinds of questions, okay? One is stuff they ask you out of the blue, which you can't anticipate, okay? The second is then if you can't answer that, or even if you can answer that, they may ask you, what have you learned? What have you studied? Okay? So in that case, you should be ready. He's not answering. Okay. Just send him a message saying that he needs to come back. So, okay. So one of the topics you can have is option strategies. You can just master these 25 option strategies in the CME book. Okay, these include some very complicated strategies. You can, one of the topics will be option strategies. Okay, you can actually and some of first and second are actually future strategies. So make sure you understand everything, but you should understand all the aspects of the situation. Okay, in this book, when you look at it, for every strategy they've given you the synthetic equivalent. Okay, and you can see now that the synthetic equivalent of the position that we had, of the long position. Okay, if we go for, what happened, Chuk? You're holding up lots of people. Now Mehak can go. Okay, guys, can you, I don't know if you can see this, but at the bottom you can see. Can you read? Are they last bench? What does it say here? Short put A. Can you read that? Is the font big enough now? Garvit is on the last bench. Can you read this at the bottom? A is here. A is the strike. Long call A, long short put A means strike. A is the strike. Okay. So this is where you see that if you see here, now these guys have not recreated the synthetic position in the Hull book, okay, but in the CME book you can clearly see what is happening, and the premium from the long, from the call and put, okay, they more or less, because what is happening when you are going long the call, you have to pay out premium. So that's a debit strategy. Okay, remember we use these terms, debit strategies and credit strategies. So the long call part is a debit strategy, but the short put part is a credit strategy. Okay, so these two will more or less balance out. Okay, it won't be exactly equal, but they'll more or less balance out. So between the two you will have this situation. So as the market rises above the strike, you'll make money on the long call. As the market falls below the strike, you'll lose money on the short put. Okay, is this clear? All right, so the premiums will more or less balance out against each other. One is an inflow, one is an outflow. So this is what we mean. Now you understand what is meant by a synthetic equivalent. That we looked at one type of position, which is long futures. We looked at one type of position, which is a long futures position, and then we created a synthetic equivalent of that by using other instruments. By using option positions, in this particular case, we created a synthetic equivalent of a long futures position by using a long call and a short put. Is this clear?
Yes, sir.
Okay, what we are trying to do? Okay, your that tone should come little later. It's now still 15 minutes left. The tone of your voice is already changing. Okay, sense of urgency. Yeah. Okay, be quiet here, guys. Be quiet. Okay, so is this clear? Now I went slowly through this to make sure that everybody understood what is the how you go through stepwise to figure out the answer, and also what now you understood what is meant by a synthetic equivalent. Okay, this is a very important concept in finance. Yes, Parul, give her the mic. Give her the mic. Yeah.
I didn't find a reason to use synthetic equivalent. But what is the use of it?
No, because it's not. It's just really for conceptual clarity. But there are certain situations where, okay, I understand your question. Why do we bother with synthetic equivalents? Yeah, this will become clearer to you when we study the concept of arbitrage. Because you'll see that, so it's a very good question actually. What she's asking is, why should we bother with synthetic equivalents? Because sometimes in the markets you will have situations where you will find that the cost of, that's why I've given you this. You should, if you really want to understand things, okay, if you really want to understand, clear your concepts, you should read the Nattenberg book also. Read your own textbook and the Nattenberg book. Your concepts have to be clear. That is your responsibility. Only you know when your concepts are clear. you should be able to satisfy yourself, and you should not stop until then. Okay, so if you read the Nattenberg book here also, if you see here, now under this particular module, positions and synthetic equivalents, which we are studying now, I have given you two references, Hull Basu 12.2, okay, and 12.2 is basically this, I think what we are looking at now. This is chapter 12. I think this is 12. This is 12.1, and I've got 12.2 here. I don't know why I've got 12.2. Actually, I should have mentioned 12.1. Or maybe it's a section. Yeah, the 12.2 is not referring to a figure; it's referring to a section. Okay, this is in your book. You'll find it. This is your textbook. So you should read this. But you'll notice that I've also given another reference, which is Nattenberg, Sheldon Nattenberg, which is also there in your finance reference book set. Okay, here you see now what is the equivalent. Why is the importance? It's a good question. Why do we need to bother with synthetics? The reason you need to bother with synthetics is sometimes you'll see that. See here a very important concept, which is important for arbitrage also, to understand the concept of arbitrage. If the results are the same, then the cost or the price of the two assets should also be the same. Okay, if there are two things which are identical, it's just like the law of one price, okay, which you might have come across earlier in your finance readings. Okay, if two instruments or two contracts, okay, give you exactly the same rights, then the price of of entering into the two contracts should be the same. Okay, so if we are able to create exactly this same profile, okay, and through some other instruments, then the cost of creating it through either route should be the same. If it's not the same, there'll be an opportunity for profit, because I can go short in one, because the positions are equal, right? So look at it this way. Now that you have the concept of synthetic equivalent, now I can go long underlying. Okay, it doesn't really cost me to go anything long underlying except for the funding cost of the premium. If I'm buying a share for $120, okay, I have to pay $120 per share times number of shares that I'm buying, so I need to fund that. So there is a cost involved with that. Okay, but what is the synthetic equivalent, as we just found out, of the long underlying at K? The synthetic equivalent is long call at K plus short put at K. Yes, okay, we found that out just now. Okay, now we can observe these prices in the market. If we go back here, we try to launch some crude oil options. Okay, so they'll take some time to launch, but the point is that I can figure out these prices, right? I can look at the market and I can figure out what is the price of a call at K and what is the price of a put at K. I can look at the market. So if I find, let's say if I find that the cost of the left, this is like a LHS RHS kind of situation, right? So this is the same as this. Okay, so if I find that the cost of the long underlying side doing this, if the cost of doing this is less than the cost of doing it this way, then what I will do is I will basically sell this side of the position and I will buy this side of the position, and I'll be able to lock in a profit. Are you following this? Okay, how exactly we are going to do it, we'll see later when we do arbitrage, but conceptually this should be clear that if two instruments are equivalent, okay, or two sets of instruments are equivalent. Here we have got one long futures on the left hand side, we have long futures. On the right hand side we have long call plus short put. Okay, we have here, let's say here, so we have a call option. If we go long the put, we are just taking the standard parameters given by this software. So if we go long the call and we go short the put, Okay, we have a net debit on this side, okay, because we have to pay out 3.09 minus 3.02 minus 2.69. Okay, then we have on the other side also, we have to look at the funding cost of the long call position, of the long underlying position. We have to look at the funding cost of that position also. Okay, but the point is, you will look at this, the net cost of doing this. What is the net cost of the right hand side here? You can see again live option prices, okay, for these different maturities. Okay. All right, so you can see all these. The point is that you can observe these prices in the market. Okay, what is the price of a call and what is the price of a put, and you look at the net cost of doing it. Sorry, this is what we need here. So you have, what you have already established is that long futures payoff profile should be the same as long call and long put, long call plus short put, with the strike price being the same price at which you are going long the futures. Right, that one is clear, that much is clear. So one, and again, what should follow from common sense, that if the two sets of positions, on the one side you have only one position which is long, but you can still call it a set of positions, okay, but and on the other side you have two positions, long call and short put. If the two of them are going to produce the same results, then the cost of entering into them should be the same, because if it's not the same, then we can make some money by taking the one which has got a higher cost and selling it, and taking the one which has got a lower cost and buying it, because then the net long and short position, the obligations should square off because the results are the same. Is this clear? Conceptually this should be clear. How exactly it will work in real life we'll see later, but the point is, conceptually this should be clear that what are we doing with synthetic equivalents? We are creating the same payoff. Okay, we are creating the same payoff, and that's why we are bringing in, remember, payoff is not adjusting for the cost of entering into the position. That's why we have the separate concept of profit. Profit adjusts the payoff for the cost of entering into the position. Okay, so in the case of options we say profit, payoff adjusted by premium gives you the profit or loss, whatever. Okay, so when that's why, and so here the cost of entering into the position. Okay, all this is already in your notes, so you can just focus on understanding. You don't have to write the stuff that is already in your notes. Okay, but now try to understand this. So if the left hand side is equal to the right hand side, then the cost of entering into the two positions should be the same. If it's not, there should be an arbitrage opportunity that we are going to, what are we going to do? Obviously we are not fools. We don't buy the one with the higher price. We sell the one with the higher price and we buy the one with the lower price. Okay, because we know that's actually the same thing, because they are synthetic equivalents. So if you emphasize the word equivalent, that means they are the same. Okay, so then if they have if the two things which are the same, they should have the same price, otherwise there's an opportunity to profit. So that's why, long answer to Parul's question, but it's a good question that takes us into this track. So this is why in finance we worry about synthetic equivalents, because we are always monitoring. That's why if you'll get a very good flavor of what I'm saying here. As I said, whatever we're discussing in the class, your education is not complete. As we can see, you're not even able to absorb and retain what is being taught in the class, but you have to go beyond this and you have to do the readings that I'm telling you to do. All these things will sink into your head if you do the Nattenberg readings also. Okay, so this concept of constantly monitoring the cost of the synthetic equivalent in the market and immediately looking for arbitrage opportunities if there is any difference. Okay, all that detail is there. You can read that book. Okay, so is this clear? That's why we worry about, basically now you understand why at a very base level we worry about synthetic equivalents. So next synthetic equivalent, guys, short underlying. Long futures, short futures. What will be the synthetic equivalent of this? Yes, Bharat, before going you can answer the question. Oh, she is going, okay. Okay. No, so Bharat can answer. Bharat can answer. Yeah. What is 1 minute? We have asked Bharat. Is the question clear? Now we are looking, we went through long underlying. We are going through one by one. What is in your notes? We have to look at 6 positions. And we have to look at the synthetic equivalents of each of those 6 positions. We have done only the first position, long underlying. We found that the synthetic equivalent is long call plus short put. Now short underlying, I've already I've given you the answer. So okay, let's see whether it makes sense. Long put, the answer is already in your notes. I should not have put it there, but anyway. So the answer is already there. But 1 minute. She's outside. How can you go? 1 minute. Okay, let's satisfy ourselves. What are you saying? So what is the answer? Long put and short call. Okay, let's see. Let's take the short call part first. Is this making sense? Let's take the right hand side of the chart first. As the market is rising above the strike price, as the market price is, this is the market price scenarios, and this is my strike price. As the market price is rising above the strike price, my losses are getting bigger and bigger. Okay, this is consistent with a short call. If I'm short the call, and as the market price rises higher and higher above the strike price, I'm losing money. Yes, Mehak? Does your WhatsApp say the same thing? Is it saying the same thing? Okay. So now tell us what is okay. Now Mehak, you answer the second part. Answer the second part. What have they said? Let's see how plugged in you are. This, what position is this? Give her the mic.
Mic now.
1 minute. Bharat, they don't have to clown around you and SG1 all the time.
Sorry.
Just be quiet and restrain yourself. Yeah. What position is this?
So this is short call.
This is short call.
Put.
This chart, what position is this? What position is this chart?
Short future.
This is a short futures position, same as a short spot position, short forward, short swap. Okay. Now we are trying to create the synthetic equivalence. One of them, they suggested, Pulkit suggested that, and others also suggested that one part should be short call.
Yes, sir.
So short call helps us with the right side of the graph, because as the market rises above the strike price, I'm losing money continuously, bigger and bigger sums of money proportionately. Okay, so that makes sense. If I'm short a call and the price is rising above the strike price, I'm losing money because the call holder is making money, right? So now what is this? This part. What is the other part of the answer? One is short call. The next one is long put. Now tell me why long put makes sense here. If I'm holding a long put, what should happen to my profile as the market? This part is for situations where the market price is falling below the strike price. When the market price is falling below the strike price, should I be making money if I'm holding a long put? Yeah? Why? I've explained this logic many times. You're too busy with your WhatsApp. Even when we separate you from your buddies, you're now looking at WhatsApp, virtual buddies, WhatsApp. Facebook users have gone up, monthly users have gone up a lot, very dramatically. In this earnings, they focus on daily active users, monthly active users. Mehak is adding to the figure. Okay, all right. So this is correct that this is a long put, because if I'm long a put, the answer should be given like this. I have the right, 1 minute, guys. Class is not over yet.
So I think this will be in the money. So
no, the way to answer it is the long put gives you, because the question was, is it consistent with a scenario where as the market price falls further and further below the strike price, I'm making more and more money, because this is what the chart is showing. The chart is showing that that's consistent, because the put gives me the right to sell the underlying asset at the strike, and the more the market price falls below the strike, the more is my intrinsic value. The greater is the intrinsic value, which means the greater the profit I can capture from exercise. So that's why this is consistent with a long put position. So the answer is correct. It is short call plus long put. Okay, this is clear? Okay, so this is done for today, but you guys have to do this. We need to move faster. Okay, we have to cover all these.
Yes, sir.
Please make sure you revise on your own at home. Okay, all right, so we'll try to cover as much as we can. We have to cover vol calc. A lot of the stuff I've already put the notes into your note, whatever we are going to cover into your notes. So you can read ahead also. At the bare minimum, cover these synthetics. Very important concepts. Make sure everybody understands it inside out. You have to practice it till you can do it in your sleep. Is this clear? No WhatsApp. You have to jam your signal. Okay.
Any technical questions?
Anybody who has
No.
who is Bharat has a question. Anyone else? No questions.